I had 3 rules. The first rule is the good trade is a hard trade. The second rule is that I want to fade the short-term trend against the longer-term trend. The third rule is that I want to put my entries where the masses put their stops.
Question of hard work and thinking, I can't keep doing this. I have to start thinking differently. I have to learn from my mistakes.
When most people start trading, they envision quick riches. They think about doubling their account in a week, maybe turning $100 into $1,000 in a month. It's the dream of financial freedom, maybe even the dream of quitting their day job. But here's the hard truth. This kind of thinking is exactly why most traders fail. If you believe that turning $100 into $1 million can happen overnight, you're setting yourself up for failure. This isn't about speed. It's about long-term growth. It's about building something sustainable, something that lasts. And this requires a shift in mindset. A mindset that isn't obsessed with instant results. A mindset that understands how small, consistent steps over time lead to massive results. This is what we call the compounding mindset. The compounding mindset is about seeing growth as a process, not a race. It's the understanding that slow, steady, and strategic growth always beats reckless, high-risk bets. And while it might not feel glamorous in the beginning, it's what creates true wealth. Think about Warren Buffett, one of the world's wealthiest investors. His secret? Patience. His ability to make slow, calculated decisions that compounded over decades, turning a small amount of capital into billions. Or look at Jesse Livermore, one of the greatest traders of all time. His success came not from gambling, but from consistent, disciplined trading, applying repeatable strategies that allowed his capital to grow steadily. This kind of mindset is what separates the traders who become wealthy over time from the ones who get destroyed by the market in just a few months. Here's the key. How you treat your $100 today is exactly how you'll treat $1 million when you get there. The average trader looks at $100 as a small amount of money, something they can afford to lose. But a millionaire trader sees $100 as a seed. And just like a seed, you don't eat it, you plant it, you water it, you protect it. Every time you look at your account and think, I need to see growth right now, you're digging up the seed. You're trying to force it to grow too fast, and it will never grow like that. In trading, this means resisting the urge to overtrade, to risk too much on one trade, or to jump into setups just because you're bored or anxious. The $100 account is the foundation. You need to treat it with the same respect you would treat a $100,000 account. Because the habits you build now, the way you manage risk and growth, are the habits you'll carry with you as you scale your account over time. Now let's break this down with some simple math. Let's say you make 5% per week on your $100 account. It's not exciting at first. On $100, a 5% gain is just $5. But here's where the magic happens. Over time, that 5% compounds. In less than 5 years, that $100 will turn into $10,000. And if you can keep the same mindset and approach, the numbers will keep growing. From $10,000 to $100,000, and then from $100,000 to $1 million. The principle is simple. Growth over time, compounded, creates results that seem impossible at first. But most traders don't see it like this. They want instant results. They risk 50% on a single trade, thinking they can turn $100 into $200 in a day. And when they lose, they get emotional, and the cycle repeats. This is exactly why they fail. If you risk too much and you lose, your account is destroyed. And worse, your emotions take a hit. This emotional instability is what drives many traders to make decisions based on fear, not logic. The compounding mindset is what separates the winners from the losers. Millionaire traders don't measure success by a single trade. They measure success by a series of disciplined actions over months and years. Take Richard Dennis, a famous commodities trader. In the early 1970s, he started with just $600. Over the next decade, he turned that into hundreds of millions. Dennis didn't do it by gambling. He did it by following consistent, repeatable rules and applying them to every trade. He let time and discipline do the heavy lifting. This wasn't luck. This was the compounding mindset in action. The compounding mindset also forces you to view losses differently. Most traders panic when they lose money. They see it as a setback. But a trader with this mindset understands that losses are part of the process. They don't let a loss derail them. Instead, they stick to the plan, knowing that consistent gains will outpace the occasional loss over time. Think of it like flipping a coin. You know that over time, the coin will land heads about half the time, and tails the other half. You don't panic when the first few flips are tails. You just wait for the next flip. That's how a trader with the compounding mindset thinks. They don't let one bad trade shake their confidence. They understand that losses are just part of the journey, not the end of the world. This emotional stability is critical. If you let one bad trade push you into revenge trading, you've already lost the mental game. And this is where many traders go wrong. They see every loss as an attack on their identity. They think they're a failure, and that feeling drives them to make impulsive decisions, taking unnecessary risks just to make it back. But a true trader knows better. They know that each trade is just part of the bigger picture. Winning isn't about making money every day. It's about following your plan, sticking to your strategy, and trusting the process. The key to mastering the compounding mindset is detaching yourself from the outcome. Not every trade will be a winner, and that's okay. As long as you stick to your strategy and maintain discipline, the results will come. But most traders don't have the patience for this. They want immediate results, and they're willing to risk it all for that next big win. But true wealth is built with time, and that's the difference between a professional and a gambler. Let's dig deeper into what makes this compounding mindset so powerful. In the first part, we discussed how small, consistent gains add up over time. But there's a critical factor that will determine whether you truly succeed in the long run: risk control. Risk control is the backbone of the compounding mindset. If you're not protecting your capital, nothing else matters. No matter how good your strategy is, no matter how skilled you think you are, if you don't know how to manage risk, the market will eat you alive. Let's go back to our $100 example. If you're risking 50% on one trade, you're playing a dangerous game. A single loss like that could wipe out half of your account. And if you're doing this over and over, it's only a matter of time before your account is completely gone. But what if you risk only 2% per trade? Suddenly, you have room to absorb losses and still stay in the game long enough to compound your way to success. Let's take a closer look at the numbers. With a 2% risk per trade, if you lose 5 trades in a row, your account is down 10%. That's a tough drawdown, but it's survivable. Now imagine that after you take your losses, you get back on track. You start making those small, consistent 5% gains week after week. Over time, the math is extraordinary. In just 5 years, your $100 could turn into over $10,000, and beyond that, into much more. The key here is resilience, not rushing to recover from a loss by risking more, but sticking to your plan and letting the numbers work in your favor over time. Patience and discipline are critical for success in trading. You might think this approach feels slow, but ask yourself, what's better, Trying to double your account overnight, blowing it up in the process, or steadily growing your account, learning along the way, and building a foundation for real wealth. When you risk too much, you end up destroying your emotional stability. The compounding mindset isn't about instant gratification. It's about setting yourself up for success over time. That's why respecting your capital is key. The trader who treats their $100 account as a seed will build their $1 million account the same way, with patience and consistent growth. Let's go deeper into risk-to-reward ratios. It's not just about the amount you risk, but also about the reward you're seeking. As a trader, you should always be asking yourself, what's my risk for this trade, and what's my potential reward? The key to long-term success is ensuring that the reward outweighs the risk. If you're risking $2 to make $4, you're setting yourself up for consistent growth. This is a 1.2 risk-to-reward ratio, a simple yet effective principle that helps you scale your profits without taking on too much risk. In a perfect world, every trade will work out. But that's not reality. Losses are part of the game. However, if you have a 1.2 risk-to-reward ratio, you only need to win 50% of the time to break even. And if you can win 60% of the time, the results are truly exponential. The compounding mindset forces you to think long-term. It's not about one or two big wins. It's about the consistency of your decisions, the control over your risk, and the discipline to follow your strategy no matter what the market does. Now let's talk about losses. In the early stages, many traders panic when they experience a loss. They see it as a personal failure. But the compounding mindset forces you to view losses differently. Instead of seeing them as setbacks, you see them as part of your learning process. The truth is, if you're consistently following your strategy and managing risk properly, the losses will not harm you in the long run. In fact, a series of small losses is a natural part of the process. It's how you manage them, how you recover from them, and how you stick to your plan that determines your success. One of the most powerful tools you can have is a clear, written trading plan. This isn't a vague set of goals like make money. A real trading plan outlines exactly how you'll enter trades, how you'll manage risk, and what you'll do when things don't go as planned. It's important to have rules for both winning and losing trades. When you have rules in place, you don't get emotionally attached to the outcome of any one trade. You simply execute your plan and move on to the next one. This emotional detachment is key to survival in trading. If you can't separate yourself from the outcome of a single trade, you'll never be able to trade with clarity. And this is where many traders fail. They let their emotions control their decisions, chasing losses or getting overconfident after a win. But the compounding mindset doesn't rely on emotions. It's about focusing on your process, your strategy, and your plan. The market doesn't care about your feelings. It doesn't care about how many trades you've taken. The only thing that matters is whether or not you've executed your plan with discipline. The market is designed to test your patience. It's full of distractions, temptations to trade impulsively, and emotional highs and lows. The compounding mindset helps you see through all that noise. It teaches you to focus on the bigger picture and let your small, consistent gains stack up over time. This is where most traders get it wrong. They're chasing excitement, not wealth. They want the thrill of the trade, the rush of making quick gains. But real success in trading isn't about adrenaline. It's about steady, calculated growth. If you can follow the compounding mindset, you'll see that the small wins add up. Your consistent decisions will pay off. It might not happen overnight, But when it does happen, it will be far more rewarding than anything you could have gotten by chasing fast profits. So let's review. Risk control. Consistent risk-to-reward ratios. A written trading plan. And above all, emotional detachment. These are the pillars of the compounding mindset. They're the core principles that will allow you to turn a small account into something life-changing. By now, you've understood the foundational principles of the compounding mindset: risk control, patience, and emotional detachment. But there's one more critical piece to this puzzle: the importance of long-term vision and consistency. The compounding mindset is all about the long game. If you're trying to make a quick fortune, you're in the wrong business. Trading is not about luck or hitting a home run every time. It's about the steady, consistent actions you take over time. We often hear stories of traders who seemingly make huge profits overnight, but we rarely hear about the countless others who risk everything in the pursuit of instant riches and lose it all. Here's the truth: no one gets rich overnight in trading. It's a process, and that process takes time, discipline, and a vision that stretches far beyond the next trade or the next week's profit. The $100 you start with is a small seed. The real challenge is not to get distracted by the quick wins, but to focus on nurturing that seed, making sure it gets the right care. Over time, that seed will grow into something much bigger than you could have imagined. But if you're constantly digging it up to check its progress, if you're trying to rush it, you're going to stunt its growth. It's the same with your trading account. If you're focused on doubling your account in a week, you're chasing short-term gains, not long-term growth. This long-term approach requires consistency. It's about following your plan day after day, month after month, and trusting the process. You're not looking for instant gratification. You're building your trading career for the next few years, not just for the next few days. Think about it. If you could grow your account by just 5% every week, that doesn't seem like much. But when you look at the bigger picture, you'll realize just how powerful that 5% can be. Let me show you something. At 5% growth every week, your $100 becomes $10,000 in less than 5 years. But here's the most important part. When your account grows, your potential for returns grows too. At $10,000, you're making $500 a week, and as you scale to $100,000, that 5% is now $5,000 a week. And the growth continues. The key is not to rush. It's to have the vision and the patience to stay on course, even when it feels slow. Because in the end, slow and steady wins the race. The temptation is always there to speed things up. You'll see traders on social media claiming they've turned $500 into $5,000 in a week. And it's easy to get distracted by that. But you need to understand that those traders are often taking massive risks. Many of them blow up their accounts soon after. Don't compare your journey to theirs. It's not about making huge profits today. It's about making smart, calculated decisions that build your capital steadily over time. You've got to trust the process. There's no shortcut to success. But what you'll find as you continue to build your account, week after week, is that the rewards are exponential. And here's the best part. Once you've adopted the compounding mindset, you've built a foundation for sustainable growth. If you can grow a small account, you'll be able to manage larger ones with the same mindset. Here's where the real magic happens. Once you've mastered the ability to make slow, consistent gains, you've unlocked the mental game. And that's the game that separates the winners from the losers. Most traders get frustrated because they're not seeing quick results. They feel the need to rush, to force a trade. But when you learn to focus on the long term, The short-term frustrations don't matter anymore. If you're constantly thinking about the short term, you're going to make emotional decisions. And those emotional decisions are the fastest way to blow up your account. But when you adopt the compounding mindset, you stop measuring your success by individual trades. Instead, you measure it by your overall growth over time. Let's take a moment to think about what success really looks like in trading. It's not about making money every day. It's about sticking to your plan, no matter what the market does. It's about following your rules, even when it's hard. And it's about building your account over time. With patience and discipline, in the early stages, you might not see dramatic results. But every small gain, every day you stick to your plan, builds momentum. The most important thing is that you stay consistent. Keep following the process day after day, and trust that the compound effect will kick in. The market will test your patience, but with the right mindset, you'll realize that every day you spend following your plan, every day you don't chase quick profits, is another day closer to your goal. And when you finally hit your goal, when that $100 becomes $1 million, you won't feel the rush of a lucky win. You'll feel the quiet satisfaction of knowing that every decision you made was based on patience, discipline, and a long-term vision. Now let's take the final step and explore the mindset that can take you from trader to professional. We'll talk about the last piece of the puzzle, adapting to the market and how to keep growing even when conditions change. We've covered a lot so far. The core principles of the compounding mindset: patience, discipline, risk control, and emotional detachment. The importance of thinking long-term, consistently building your account, and focusing on steady growth. But there's one final aspect that will ultimately separate the successful traders from those who fade into obscurity. That aspect is relentless adaptation. The markets are dynamic. They change. They shift. What worked last month might not work this month. Trends that were strong yesterday could be irrelevant today. And if you're rigid in your approach, if you insist on doing things the same way even when conditions change, the market will punish you. Adaptation is not just a skill for traders, it's a survival mechanism. The traders who thrive long-term are those who can continuously adapt to the market's ever-changing nature. You don't need to predict the market perfectly. In fact, trying to predict every move is a fool's errand. What you need to do is observe, adapt, and respond to the market in real time. Successful traders know when to adjust their strategy, when to reduce their risk, and when to take advantage of new opportunities. The best traders aren't married to one strategy. They use multiple tools, they have multiple plans, and they know how to switch between them depending on the current market conditions. Think of your trading strategies as tools in your toolbox. There is no one perfect tool that works in every situation. A hammer is great for nails, but it won't help you fix a leak in a pipe. Similarly, a trend-following strategy may work well in a trending market, but during a choppy, range-bound period, you might need to switch to something more suited for that environment. If you insist on using one tool for everything, you'll find yourself getting stuck. But if you can adapt, if you can stay flexible and use the right strategy for the right market conditions, you'll be much better off. This is where ruthless patience comes into play. Adaptation doesn't mean you jump at every opportunity. Just like a lion waits for the perfect moment to strike, you need to wait for the market to offer you the conditions that align with your strategy. Ruthless patience means that you don't act impulsively. You don't chase every move the market makes. You wait. And when the right setup presents itself, when the odds are stacked in your favor, you strike with precision. Adaptation also means knowing when not to trade. Some days you'll feel sharp, others you'll feel distracted or emotionally charged. An adaptive trader knows to adjust their position size or frequency, or maybe even take a step back and not trade at all. This is the core of mental adaptation, adjusting not just to the market, but also to your own mental and emotional state. Some days are better for trading than others, and if you've built a consistent approach based on discipline and flexibility, you'll know when to push forward and when to pull back. The real test of your trading ability comes when the market shifts unexpectedly. Maybe there's a sudden spike in volatility, or a trend reverses out of nowhere. If you're rigid, you'll panic. If you're adaptive, you'll assess the situation calmly and adjust your strategy to fit the new conditions. In the past, during the global financial crisis of 2008, many traders who had been relying on long-term strategies found themselves caught off guard. They couldn't adjust to the new reality. But those who adapted to the new environment, those who switched to short-term trading or refined their risk control, didn't just survive. They thrived. The market is a living, breathing organism. It's constantly evolving. The traders who are able to adapt, to move with the market instead of against it, are the ones who succeed. Adaptation doesn't only apply when the market shifts, it also applies when things go wrong. Losses are inevitable, but what sets the successful traders apart is their ability to learn from their mistakes. If you're rigid and attached to your ego, you'll keep trying to make your strategy fit, even when it's clearly not working. But if you're adaptive, you'll step back, reflect, and make the necessary adjustments. Each loss is a lesson. Each mistake is an opportunity to refine your process. Traders who refuse to adapt, who cling to the belief that they know best, are the ones who lose it all. Adaptation is about relentless improvement. The best traders are constantly evolving. They're constantly reviewing their performance, tweaking their strategy, and testing new methods. This doesn't mean that they're always changing what works, but they're constantly trying to get better. Adaptation is the key to scaling. As your account grows, your approach needs to grow with it. If you started with $100, your strategy was focused on small, steady gains. But once you have $10,000, your strategy needs to shift. Your position sizing, your risk tolerance, even your goals, they'll all evolve as your capital grows. To master adaptation, you must also understand the role of emotional detachment in this process. The market doesn't care about your emotions. It's just a reflection of the choices you make. When you remove the emotional attachment to any one trade, you allow yourself to adapt freely. You stop making decisions based on fear or greed. You make decisions based on logic and probability. Adapting is not about being reactive. It's about being proactive. It's about recognizing when the market conditions change and having the foresight to adjust your strategy before things go wrong. It's about refining your process every step of the way, without hesitation, without ego. In the end, the traders who succeed are those who understand that growth comes through adaptation. The market will always change. But if you can adapt, if you can shift your strategy and mindset with the market, you'll always be one step ahead. The final piece of the puzzle is simple, but it's the hardest to master. You have to adapt, not just to the market, but to yourself. You have to keep evolving, refining, and improving, so that when the opportunities come, you're ready to take them. The road to success in trading isn't easy. It's a journey of relentless growth. But if you can master the 4 cornerstones, discipline, patience, resilience, and relentless adaptation, you'll build a foundation that will carry you to the financial freedom you're working towards. Remember, the market is a reflection of your mindset. If you bend, shift, and adapt, it will carry you forward. If you resist, it will break you. Subscribe for more trading insights, and don't forget to share your journey in the comments below. We read every single one.